In the next 60 seconds, construction crews in Texas will pour over 40,000 cubic yards of concrete. That's enough to build a new single-family home every minute. The cost of that concrete is quietly determined by a handful of companies, and one of them is making a strategic play to control the literal ground beneath America's fastest-growing cities. This isn't a story about software or silicon. It's about stone. And the company executing this takeover is one you've probably never heard of. But its decisions will dictate the cost of every new road, hospital, and skyscraper for the next 50 years. The company is Vulcan Materials, headquartered in Birmingham, Alabama. With a market capitalization over $30 billion, it is the largest producer of construction aggregates in the United States. Aggregates are a simple, unglamorous product: crushed stone, sand, and gravel. They are the main ingredient in concrete and asphalt. After water, aggregates are the most consumed material on the planet, but they have a fatal economic flaw. They are heavy and therefore expensive to transport. A ton of crushed stone might cost $15 at the quarry, but shipping it 50 miles can double its price. This creates what economists call natural local monopolies. The quarry closest to the job site wins, and Vulcan has spent decades buying the quarries closest to America's future job sites. The real story isn't about stone, it's about location, and here is the part of their strategy that almost no one sees. Between July 2020 and July 2021, Texas added over 310,000 new residents. To house them and employ them, the state is in a permanent construction boom. The Dallas-Fort Worth Metroplex alone is projected to spend over $140 billion on infrastructure by 2045. For Vulcan Materials, these aren't demographic statistics, they are order backlogs. They operate over 100 aggregate facilities in Texas. But simply owning the supply of stone wasn't enough. They needed to control the demand, too. They needed a checkmate move that would lock out competitors for a generation. And in 2021, they found it. On June 7, 2021, Vulcan announced its acquisition of U.S. Concrete for $1.29 billion. Wall Street saw it as a simple expansion, but it was a masterstroke of vertical integration. U.S. Concrete wasn't just another quarry operator. They were one of the biggest buyers of aggregates in Texas, California, and New York. They owned 127 ready-mix concrete plants. By buying U.S. Concrete, Vulcan wasn't just acquiring a competitor. They were acquiring their own biggest customer. They now controlled the rock in the ground, the trucks that hauled it, and the plants that turned it into the finished product. This single transaction created a closed-loop system in some of America's most critical construction markets. The question is, how can a move that consolidates so much power be legal? Antitrust regulators at the Federal Trade Commission are supposed to prevent acquisitions that substantially lessen competition. But the aggregates industry is uniquely difficult to regulate because the market is local. A national giant like Vulcan can argue that buying a competitor in Dallas has no competitive impact on the market in Denver. They can make dozens of these local acquisitions one by one until they've built a regional fortress. According to the U.S. Geological Survey, the top 10 companies now control over 35% of the entire U.S. crushed stone market. Smaller, family-owned quarries can't compete with Vulcan's scale, capital, and logistical power. They are faced with a simple choice: sell out or be priced out. And Vulcan's blueprint wasn't just for Texas. They were already running the same play 1,000 miles northwest. Colorado's Front Range, the corridor from Pueblo to Fort Collins, is another epicenter of American growth. Denver's population has surged nearly 20% in the last decade. And just like in Texas, Vulcan Materials has been methodically acquiring the strategic assets needed to supply that boom. They operate key quarries and asphalt plants that service the entire Denver metropolitan area. By controlling the quarries with long-term mining permits that are increasingly difficult for new players to obtain due to environmental regulations and local opposition, Vulcan is cornering the market not just for today, but for decades to come. This raises a critical question for every resident of these booming cities. What happens when one company has a chokehold on the most essential building material? When competition dwindles, prices rise. It's the oldest rule in economics. From 2020 to 2023, the price of ready-mix concrete in the U.S. jumped by over 25%, according to the Bureau of Labor Statistics. While inflation played a role, so did market concentration. These increased costs don't just get absorbed by construction companies. They are passed directly on to taxpayers for public works projects, roads, bridges, airports, and to homebuyers in the form of higher housing prices. A few extra dollars per ton of gravel sounds small, but multiplied across the millions of tons needed for a new highway interchange or a downtown skyscraper, it amounts to billions in transferred wealth. It's a hidden tax on growth, paid by everyone. But from the boardroom, this doesn't look like a problem. It looks like a brilliant strategy. In Vulcan's 2021 annual report, then CEO J. Thomas Hill described the U.S. concrete acquisition as a move that would enhance our geographic footprint and provide a new growth platform. For shareholders, this is exactly what they want to hear. The company's stock price has more than doubled over the past 5 years. From their perspective, they are not building a monopoly. They are building a fortress with an unbreakable competitive moat. They are creating efficiencies, securing their supply chain, and delivering predictable returns in a volatile world. They are playing the game exactly as it's designed to be played in a capitalist economy. The problem is, the game itself may be flawed, especially when the assets being consolidated are irreplaceable. But here's the most powerful part of Vulcan's moat, the one that regulators can't touch. You can't import a quarry. You can't outsource a gravel pit to another country. Due to geology and zoning laws, the number of viable quarries is finite. Environmental regulations and NIMBYism, the not-in-my-backyard phenomenon, make it almost impossible to get a permit for a new quarry anywhere near a growing city. Vulcan isn't just buying companies. They're buying the last of a non-renewable, geographically fixed resource. Every quarry they purchase is one less that will ever be available to a competitor. It's a quiet, patient, and permanent consolidation of the literal foundation of America. This isn't a story of good versus evil. It's a story of strategy. Vulcan Materials identified a fundamental truth of the modern economy. The most valuable assets are not digital bits or complex financial instruments, but scarce, essential, and geographically locked physical resources. While the world was focused on the cloud, they were buying the ground. Their acquisitions in Texas, Colorado, and across the Sun Belt are not random acts of expansion. They are deliberate moves in a decades-long chess game to control the building blocks of American prosperity. If you liked this breakdown of corporate strategy, you'll love our deep dive into the silent war being fought over global shipping lanes. Click the video on your screen now, and subscribe to Compound Path for more business stories that change how you see the world. What's one industry you've seen become dominated by just one or two companies in your own city? Let me know in the comments.